I've been tracking silver closely, and what just unfolded is one of the most aggressive, most deliberate crashes in precious metals history. We're talking about a 22% plunge in just 2 hours, dropping from $90 down to $73 overnight on the Shanghai Futures Exchange. Right now, Western Spot is sitting at 75, Western Futures at 76, Shanghai Spot at 86, Shanghai Futures at 90. That's still a $10 premium holding in China, even after this massive sell-off. Gold is trading at 48.21. After my last video covering JP Morgan's planned manipulation, I got flooded with messages from people saying they were automatically unsubscribed or stopped receiving notifications. That's what happens when you tell the truth. I'm going to keep delivering verified news, solid data, and both sides of every story, whether we're talking about manipulation or accumulation. You'll always get the complete picture here. No hype, no greed, no fear, no nonsense. Let's break down what actually happened, because this wasn't just market movement. This was warfare. In my previous video, I pointed out we had no daily close above $90. I've been highlighting the $87 to $90 zone as major resistance for days now. This isn't hindsight analysis, it's all documented in the earlier videos. We tested that level, got rejected, 3 times with bodies closing below it, showing mounting pressure and resistance. We've been tracking both the technical patterns and the broader fundamentals. This isn't gambling, it's planning based on verified data. The copycats out there will manufacture some dramatic bank crash narrative to explain what happened after the fact. But the real-time information was shared as it developed. So what actually triggered this 22% overnight rejection from 90 down to 73? Let me walk you through the timeline, because this gets genuinely fascinating. On Tuesday, 3 million ounces were pulled from COMEX vaults. That's not a typo. 3 million ounces. Nearly 2 million ounces withdrawn from Asahi, over 900,000 ounces withdrawn from HSBC, another 282,000 from JP Morgan. 2.5 million ounces adjusted into Loomis registered. Total COMEX silver inventory dropped to 400 million ounces. That's a single-day drain we haven't witnessed in years. Physical metal is actively leaving the system. Here's the contradiction that everyone needs to pay attention to. While 3 million ounces are being pulled from COMEX, 600 more silver futures contracts received delivery notices in just the first 4 days of February, all accepted for physical delivery. That's over 3,500 contracts in 4 days, representing 17.5 million ounces. Normally, only 1 to 3% of contracts settle physically. Right now, we're seeing 100% physical settlement. You can't build AI data centers with paper silver. You can't manufacture missiles with paper contracts. The world needs actual metal. Now compare that physical tightness with what happened overnight on the Shanghai Futures Exchange. This is genuinely one of the most remarkable events in the history of Asian commodity markets. 1.4 million contracts traded on the April 2026 silver futures alone during a single morning session. That's equivalent to 674 million ounces of paper silver across all contracts that morning, totaling 1.34 billion ounces traded. That's almost double the entire annual global silver mine production traded in one morning. Let that sink in for a moment. This wasn't retail panic selling. This was a brutal, systematic short-selling attack designed to intentionally crash the Chinese silver market. But here's what's crucial. Prices remained at a significant premium versus COMEX and LBMA. Silver stayed in backwardation. The paper games aren't changing the underlying fundamentals whatsoever. Then we see dislocation signals that even experienced risk managers are calling unfamiliar. Spot price dropped $9. London spot moved into backwardation versus COMEX. The exchange for physical spread is signaling tightness in London, even as leverage gets unwound elsewhere. Regional divergence is screaming. London currently has the best bid. China and the US are aggressively deleveraging. What does this tell us? We're in a broad global deleveraging cycle where futures are being sold while physical metal is being absorbed. Metal leaving the US and China appears to be largely speculative selling. Flows into London appear to be physical demand-driven. That imbalance explains the current spread behavior. This doesn't necessarily mean an imminent price rebound. Let me be absolutely clear about that. This reflects stress in a leverage-driven system. The underlying dynamic appears to be a breakdown in the financialized market structure, with behavior reverting towards spot market fundamentals. The invisible hand isn't operating freely anymore. It's been replaced by visible state action, regional policies, taxation, price floors, government intervention. These aren't theoretical concepts anymore. They're happening. The Shanghai Futures Exchange just announced new margin requirements for precious metals starting Monday. Daily price limits for silver futures adjusted to plus or minus 20%. Margin requirements for hedging positions up to 21%. General positions up to 22%. They're tightening the screws because the system is under stress. Here's where this gets really interesting, and I want you to connect these dots with me. Picture this scenario. You're short silver at $70, then a government sets a price floor at $80. What happens? You're instantly underwater, not because of market volatility, but because of policy. There's no pullback, no dip to cover your position. Trading below $80 is no longer permitted. Your loss is locked in at $10 per ounce, $50,000 per COMEX contract. Margins get raised, liquidity disappears, you face a margin call or forced liquidation. Here's the part that should terrify anyone playing the paper short game. If physical silver is tight and delivery gets demanded, your paper short turns into a physical obligation. No metal available? You pay whatever price necessary or cash settle with penalties. This isn't a normal short squeeze. This is a state-backed repricing. A price floor doesn't protect short sellers, it eliminates them. You can short the paper all you want, but you can't short a floor. The moment a floor gets set, the old silver market is over. Could that floor be set below 80? Absolutely. But if it's set too low, metal disappears. Miners don't invest, refiners slow down, physical supply dries up. Then the state either raises the floor quietly, buys metal directly, or subsidizes the gap. In other words, a low floor just delays reality. The real floor isn't a number, it's where silver refuses to sell. Meanwhile, CNBC anchors are mocking silver investors because silver traded above $120 and is now at $79. But silver investors are still up 150% over the past year. Bitcoin is down 26% over the past year and even further below its high after erasing the entire gain it made since the election. But nobody's mocking Bitcoin holders with the same energy. Let me address the resistance and bearish factors head-on, because balance matters. This deleveraging is real. Speculative positions are being liquidated. Margin calls are forcing weak hands out. The environment is unfamiliar even for seasoned traders. Markets are sending conflicting signals because events are unfolding in stages. Clarity will only come once deleveraging runs its course and the dust settles. If we close below 73 to 74 on a daily candle, not a prediction, just a technical level, we could see 70 and below. That's a realistic downside scenario in the short term. But here's what's critical. None of that changes the structural deficit. None of that changes the fact that 100% of COMEX contracts are settling physically. None of that changes the 3 million ounces drained in a single day. None of that changes Shanghai maintaining a $10 premium despite the overnight crash. None of that changes the fact that the LBMA benchmark snapshot was taken and Chinese shorts should now be trapped in their positions. JP Morgan likely closed billions in shorts at the bottom, and demand for physical metal is accelerating. The state of Wyoming just started buying physical gold and selected a private vault over JP Morgan. That's not speculation, that's official. Institutions are waking up to the reality that traditional portfolio construction, 60% equities and 40% bonds, doesn't work in this era. US 10-year bonds are down 50% since 2020. Gold is up 3 times. Current US gold holdings in portfolios average 1.4%. Imagine what happens to the price of gold if even a portion of that 40% bond allocation shifts into gold. And silver moves with gold, but with industrial demand layered on top. UBS just came out and said they believe both gold and silver can move even higher in 2026. Pullbacks this violent in a secular bull market usually mark the start of the next leg up, not the end. Institutional conviction hasn't wavered. The artificially low prices created by these raids are building the conditions for a major bull market in silver, because they create even more real physical demand as supply dwindles. JP Morgan was fined nearly $1 billion for manipulating precious metals markets. They paid the fine and kept doing it. The markets are rigged. That's why you take self-custody and get out of paper. In just 90 minutes, silver was systematically smashed. Anyone still leveraging silver on COMEX or trusting paper contracts and silver ETFs needs to wake up. These instruments are designed to drain retail capital, not protect it. Forced liquidations transfer real wealth to the same players every single time. JP Morgan, State Street, BlackRock, via CME, the owner of COMEX. Same playbook, same outcome. Paper silver and physical silver are at war. Paper shorts pushed prices down 22% in 2 hours. At the same time, the physical market is being drained every single day. The most telling signal is coming from COMEX settlement behavior. This is the disconnect. This is the breaking point. Let me frame what's actually happening here in simple terms. Jesse Livermore wrote in Reminiscences of a Stock Operator that the market will do whatever it takes to prove the maximum number of people wrong. This crash just shook out everyone who was over-leveraged, everyone who bought the breakout at 90 without a plan, everyone trading on emotion instead of structure. The strong hands are accumulating physical at these levels. The weak hands just got margin called out of existence. So where do we go from here? I'm watching 3 things closely. First, can we hold 73 to 74 as support on a daily close? If we break below with conviction, 70 and lower is in play short term. Second, does the Shanghai premium expand or contract from here? If it widens, that confirms the physical bid is stronger than the paper selling pressure. Third, do COMEX registered inventories continue bleeding? Because if delivery demand stays at 100% and inventory keeps dropping, the squeeze isn't theoretical anymore, it's mathematical. What are you expecting? 70 or below? Or can we bounce here? Not financial advice. I want to know what you're seeing in your analysis. 3 key takeaways. First, this was a leverage unwind, not a fundamental breakdown. Physical demand indicators remain strong. Second, regional divergence is creating opportunities, but also extreme volatility, so plan accordingly. Third, the paper market structure is under stress in ways we haven't seen before. State intervention, price floors, margin hikes, these aren't normal market dynamics. Do your own due diligence. I will never ask for your money. Never pitch invest with me. Never run paid signals or funds. Protect your capital and stay far away from scams using my name. If this added value, share it with one person who needs unfiltered truth over hype. The unresolved tension we're witnessing is a system transition in real time, from paper-driven price discovery to physical-driven price discovery. How long that transition takes, how violent it gets, and where the floor actually settles is still being written. But the direction is clear. Invest with logic, not hype.